Today, we're going to look at what happened over in the US with the Fed's decision and set it in a broader context, which raises some very interesting questions about the future of the Fed and its relationship with the Treasury. Yesterday's Fed decision to hold their cash rate, despite two dissenters on the FOMC, Governors Christopher Waller and Michelle Bowman, who both were Trump appointees, by the way, voted 9-2 to hold its benchmark federal funds rate in the range of 4.25 to 4.5%. This was an interesting object lesson in, let's call it, two Americas. One based on the current data showing balanced employment and growth, despite, though, millions of Americans saying jobs are suddenly hard to get, even as inflation refuses to be tamed, while the impact of tariffs have yet to be fully seen. But the other America is that many are doing it tough already, with high interest rates hitting mortgage rates and home buyers and indirectly pushing government borrowing costs up, both linked, of course, to the longer-term yield curves, which continue their upward path. Of course, American consumers will end up paying taxes on the tariffs. That's because tariffs make imported goods more expensive. So when Americans buy those goods, the sales tax is applied to the higher price. So in effect, state and local governments tax the tariffs. But the committee's decision followed what Powell called a good meeting to hold steady once again. And they defied the intense pressure from President Donald Trump to cut rates. Moments before the decision, Trump predicted the Fed would lower rates in September and criticized the central bank again for not moving more quickly. Trump, of course, has been focusing on the cost of debt and the rate cuts running across many other countries. But Federal Reserve Chair Jerome Powell shrugged off pressure from the White House and rejected arguments for an interest rate cut from the two dissenting officials, maintaining the central bank needed to stay on guard against inflation risks. It also raises broader questions about the role of Treasury versus the Fed. It seems that as Powell holds firm on the cash rate, over at the Treasury, Scott Bessent is executing a very deliberate, forward-leaning restructuring of usury Treasury issuance that blends, financial repression, soft yield curve control, and liquidity engineering, all without overtly stepping on the Federal Reserve's turf. He is effectively re-architecting the Treasury's role as a macroeconomic actor.